Hey everyone, testing the mic. Can you hear me?
We can hear you.
Looks well.
Cool. Awesome. Hey everyone, my name is David Gogel and I'm the growth lead at dYdX. I'm excited to be joined by Antonio Juliano, the founder and CEO at dYdX, and Uri Kolodny, the co-founder and CEO of StarkWare. In the next hour, we'll be discussing community questions around dYdX's recent launch of cross-margin perpetuals on layer 2 powered by StarkWare. Please submit any questions that you have in the chat on our Discord, in the AMA channel, or on our YouTube live chat. Antonio, Uri, thanks so much for joining today.
Thanks for having us. Excited to be here.
So to kick things off, I was hoping that both of you could briefly share more about your backgrounds and how you started dYdX and StarkWare. Antonio, maybe you can kick it off.
Sure thing. So I kind of got into crypto back in 2015 when I got my first job out of college at Coinbase. And while I was at Coinbase, was really fortunate to have the opportunity to work with a ton of the really best people in the space at the time. And that was right around the time when Ethereum came out. And we had a really great front row seat in terms of seeing the exciting developments there. Basically, like Vitalik came and talked to us pretty early on at Coinbase, and that got all of us pretty excited once we wrapped our head around what was possible with Ethereum. And I was pretty convinced at that point that there would be something that was really interesting to build on kind of this new computing paradigm that is smart contracts running on the blockchain. But I wasn't really sure what it was at that point. And then a few years later, ended up starting dYdX. We've been around for a little over 3.5 years now. Right around the time when I started dYdX was just basically right after the very first decentralized exchanges had come out. So things like 0x, things like Kyber. So took a look at those, saw they were pretty interesting, especially for spot trading, and figured the next kind of logical thing to build after that would be more advanced types of financial products like margin trading and synthetic products.
Great. Uri, do you want to go ahead?
Sure. I'm a little older than both Antonio and the average guy you bump into in the blockchain ecosystem, but a relative newcomer to the blockchain ecosystem. So I'm an old friend of Eli Ben-Sasson, my co-founder and partner at StarkWare. Going back to our days in the Israeli intelligence many years ago. And he was a CS professor at Technion for a good number of years. Back in 2017, he said, I have the technology I've been working on for a good while. Let's build a company around that. And together with Michael Ryabtsev, who was a PhD student under him, and Alessandro Chiesa, who was a professor of CS at UC Berkeley, we started StarkWare. I've been an entrepreneur for the past 20 years. And StarkWare is focusing on building scalability solutions with permissionless blockchains, relying on zero-knowledge proofs, and in particular on the Stark proof system, which you'll hear about more.
Great. So, just recently, dYdX and StarkWare announced cross-margin perpetuals on layer 2 powered by StarkWare. Antonio, can you kick things off and just explain to the audience what are perpetuals and what are they used for?
Yeah, absolutely. So perpetuals are a synthetic product that's really popular in crypto. It's quite literally the biggest product in crypto by volume, bigger than kind of all of the rest in trading in crypto put together. And because they're synthetic, basically what that means is when you're trading these products, say you're trading like a Bitcoin perpetual, there's none of the actual underlying currency involved. So when you're trading a Bitcoin perpetual, there's no actual Bitcoin involved under the hood. It's basically just this synthetic contract that has some mechanisms, most notably this thing called the funding rate. A funding rate is just a dynamic interest rate that's kind of paid between those who are long the contract and those who are short the contract, which basically tethers the price of this synthetic contract to the price of the underlying asset. And the reason that they're so popular in crypto is because they can be traded with very high leverage. So these, financially, it's basically the same thing that was popularized by BitMEX and now is really popular on a bunch of different exchanges from Binance to FTX to others. And these are kind of where you see the 100x leveraged kind of products of the world. But even if you don't want to use that high leverage, they're still really useful for trading because they let you trade as if you had more capital. So suppose you kind of came to dYdX with $100 worth of capital you can immediately start trading as if you had 1,000 or potentially even more capital based on kind of the leverage that you're willing to take on. And this just lets traders trade in a much more capital efficient way. And that's why they're so popular.
Great. And so obviously recently there was a big announcement that dYdX moved to layer 2. Antonio, could you describe why dYdX decided to move to the layer 2 and share some of the benefits of the new layer 2 product versus the layer 1 product versus trading perpetuals on centralized exchanges?
Definitely. So in terms of why we moved to layer 2, the biggest reason is probably pretty obvious for anybody who's used DeFi before, and that's just the extremely high gas fees that our users have had to pay for the past couple months now. It's gotten pretty bad to the point where on our layer 1 products, it was costing our traders around $100 on average to execute a single trade. And that would oftentimes spike up to literally over $1,000 sometime, especially in the times when traders want to trade most. And that's just really untenable if you're an exchange. Like, who's going to use an exchange where you have to pay hundreds of dollars per transaction? Probably not that many people. So that was kind of the biggest motivator behind our move to layer 2. And I'm sure you can talk a lot more about this, but StarkWare is able to offer just a ton of really great scalability. And that's kind of the main selling point or main advantage of our new product. But it doesn't really stop there. There are a bunch of other really important benefits that are kind of unlocked by StarkWare's platform that we have kind of built into what we think are really attractive features for traders on the exchange. So the first thing is this thing called cross-margining. And David, that's kind of what you were alluding to and kind of what our new product is. What cross-margining is now you can have a single account, kind of a single pool of collateral on the exchange. And you can use that to collateralize all of the different positions that you might want to trade. So you could basically deposit one time and start trading, Ethereum, start trading Bitcoin, start trading Link, start trading a bunch of the other assets that we'll still soon add on the exchange. Whereas before on layer 1, we only supported what was known as isolated margining. Isolated margining basically means that for every different market that you want to trade, you have to collateralize that account separately. So in kind of the same example where you wanted to trade multiple assets on the same exchange, you would have had to deposit once for every single different market that you wanted to trade on. So this is obviously pretty bad for users, and kind of the new cross-margining is a much more capital efficient way to trade. But it's especially really impactful for market makers, because market makers want to trade on all of the different markets that dYdX supports as well. And on our old system, which only supported isolated margining, which was basically a side effect of kind of the reduced amount of scalability that's available on layer 1, suppose dYdX wanted to launch a bunch of markets, say like 50 markets. If dYdX only supported isolated margining, market makers would have to deposit once per market, or like 50 times in that example. And obviously that's just pretty ridiculous and would impose a really, really high cost of capital on them. And that's kind of the main reason why we were unable on our layer 1 products to launch a lot of new markets. Whereas now with the new cross-margin system, market makers can just deposit one time and then just start quoting every single different market that dYdX may offer. And it's a much, much more capital efficient way for them to trade. And I'm sure we'll touch a lot more on this pretty soon. But that's going to unlock us just being able to launch a ton of new markets on dYdX. We're targeting roughly launching 50 or so in the next year. Besides that, it's basically what we did with the layer 2 product is completely rebuild it from the ground up. It's not like we just took our existing layer 1 product and kind of ported it to layer 2. We rebuilt the entire user interface. We built all of kind of the backend order book, backend matching engine, obviously built on StarkWare scalability solution. So we think it's a much more, like a vastly improved UI, basically. I think kind of one of the main selling points and one of the things that I think makes it feel pretty magical is that it's a truly instant trading experience. Like now when you trade on dYdX, your balances just update immediately or as fast as they would on a centralized exchange, which is really different than probably what pretty much everybody is used to from using DeFi apps. Like normally when you use a DeFi app, you say, make a transaction to Ethereum, and then you have to wait for it to get mined and kind of are used to seeing a spinner on the page until your transaction actually gets mined. So I think the user interface is vastly, vastly improved. And then just the last really important benefit that I'll touch on is being able to offer higher leverage safely on the platform. And the reason this was kind of unlocked and the reason that we can do this is because now we have much, much more performant Oracle prices. And I think what we were able to do with the Oracle prices is pretty cool. So basically, we are working with Chainlink and kind of MakerDAO to basically port the exact same Oracle systems that they have, and the exact same security, exact same decentralization that's kind of leading the existing layer 1 Oracle solutions, but instead put those Oracle prices on layer 2. And the really cool thing about that is now the prices and the price updates are much more performant. And kind of the main thing that you have to think about when you're running a leveraged exchange in DeFi is how long does it take for the actual price to be updated, or basically for the, like, once the price changes, like how long does it take to reflect that price change in your system? And that was a really long time on layer 1. So to kind of give you a sense, it would oftentimes take 5 to 10, sometimes up to 15 minutes once the price of an asset changed for it to actually be reflected on layer 1. And that's just kind of due to the time it takes to get the price recorder transactions mined to the blockchain. Now we've gotten it down to basically single-digit seconds. So instead of taking minutes, it takes seconds. And that's what really unlocks us to be able to offer higher leverage much more safely, because we can liquidate people and keep the health of the system as good as centralized exchanges can.
Thanks, Antonio. It sounds like there's just a ton of benefits for the overall product by moving to layer 2. So Uri, maybe you could explain more about how layer 2 and ZK Rollups work.
Sure. So just before I go into that, I sort of want to drive home the point that Antonio made, which was, in a way, I think, a revelation for both our teams, that the layer 2 solution, the StarkX solution, goes well beyond just scaling the system. It results in a fundamentally better system, better UX, safer system, more efficient system. And that's a remarkable outcome, a remarkable sort of lesson that we've learned over the past 6 months. So what are layer 2 and what are ZK Rollups? So layer 2 is a very basic idea that's been around for a few years, and it essentially says, let's move computation, whatever activity has been taking on the blockchain itself, which was layer 1, let's move that to a cheaper environment, right? Let's think of Ethereum as whatever, downtown Manhattan. Let's move out to the cornfields of the Midwest and compute there on a cheaper platform, and then let's go back periodically to layer 1 and bring the results of our computation and storage updates and whatnot, and share those on the ledger. Now that's sort of the basic premise of a layer 2 scaling solution. There are 2 flavors. We'll talk in a little bit about those 2 flavors in particular: optimistic rollups versus ZK rollups. But ZK rollups belong to a family that we refer to as validity-proof systems. Validity-proof systems basically says that you take whatever computation you want to take, and in the context of exchanges, and certainly in the context of dYdX, that computation, that large computation, is merely a batch of many small trades, of many small computations. So you take this computation off-chain to layer 2, and now you generate a proof attesting to the validity of that batch. What do I mean by that? That we check that the signatures are valid, and that the balances were sufficient, and whatever conditions, whatever business logic the exchange dYdX wanted to impose here, that all those were met on layer 2. Now, magically, we present this Stark proof. I'm saying magically because it is a trustless system. This proof can now be verified directly on the blockchain. And once it is verified, we know that the system, that the exchange transitioned from one valid state of balances to a new state post this batch of transactions. And this is final, right? There is no dispute window. There is no need for anything, because we know that by definition, we've transitioned from one valid state to another. So in a very hand-waved fashion, this is sort of the basic notions behind the ZK Rollups.
Great. And so you mentioned kind of different flavors of layer 2 and ZK Rollups. Can you maybe describe what some of the trade-offs are between the different modes of StarkX, and why choose ZK Rollups over Validium?
Okay, so some terminology. So in the question now, once we've proven the integrity of a batch of transactions, where do we record that transaction data? Do we record it on-chain on Ethereum or not? Now, recording it on-chain, this is what is referred to as on-chain data. is an expensive proposition. It's an expensive proposition because gas prices may fluctuate, etc. This is the lion's share of the cost of operating a rollup. It's in fact the cost of recording data on chain. It's not the cost of verifying the zero knowledge proofs. So on the one hand, it's expensive. On the other hand, the benefit is that the user needs to rely on no one, not on dYdX or StarkWare or anyone else. They know that if the system breaks down, the off-chain system breaks down in whatever spectacular fashion, their balances, their assets are secure on layer one, and they can easily move on to with their lives. So that's a rollup mode. Validium mode, we say we keep the data off-chain. So here we say we don't want to incur the cost of storing all this data, transaction data on-chain. Let's store it in a distributed fashion amongst a set of committee members who attest that they see valid transitions in the state of balances off-chain. And their job is to ensure that the data is made public in the sort of unlikely case that both dYdX and StarkWare vanish off the face of the earth or become malicious. So there is a trade-off here. Diversify, which was the first deployment that we put out on the field, chose to operate in Validium mode. dYdX chose to operate in rollup mode. This summer, we're actually putting out what we call Volition. Volition, as the name suggests, is a hybrid mode where the choice of whether data is going to be on-chain or off-chain will in fact be in the hands of users at the transaction level. So it will no longer be a system trap, but a choice that every user can make at the transaction level. And that's sort of the highest degree of freedom that we can make.
Awesome. And I guess, Antonio, when looking at different scaling solutions and different layer 2 options, ultimately, what drove the decision behind dYdX choosing StarkWare as the desired layer 2 solution?
Yeah, I think there are a bunch of different factors that kind of went into this decision. And kind of the main things that we were kind of deciding between, as Uri alluded to, basically all of the leading scaling solutions we considered. So obviously ZK Rollups with StarkWare. We considered optimistic rollups. Optimism is kind of the leader there. And then we considered other layer 1 chains as well. Maybe I'll talk about other layer 1 chains first and kind of our thoughts on that. First of all, I think both those and kind of optimistic rollups are still relatively unproven, still relatively untested. One of the big draws for us to kind of zero knowledge rollups, and specifically the work that StarkWare has been doing there, is that they were already production ready. StarkWare has been live now for I think like almost a year or so, or potentially more, with a different decentralized exchange called Diversify, using a similar technology. And it hasn't had basically any problems, and they've been able to run that at a really high level in production. And our users are facing all of these problems that I kind of alluded to before right now. And it was really important for us to scale our exchange as soon as possible, not like theoretically at some point in the future. So kind of production readiness was a really big factor in our decision. Some of the other factors are for things that are not rollups. So basically there are other layer 1 chains. So think like Solana or Near or Polkadot or something like that. Kind of the issue there, and this is not really an original thought, because a lot of people will say this, and I think it's true, is that just a lot of the ecosystem around those blockchains is not nearly as developed as what has been developed in DeFi on Ethereum. So things like developer tools, things like wallets, things like people owning the underlying asset that you have to own to pay gas, things like cross-chain solutions to get people's coins over there in the first place are all still pretty nascent. And just being able to roll up directly on Ethereum, and as Uri said, just have all of the great decentralization and security benefits that Ethereum brings, but not have to compromise in terms of scalability is just a really awesome proposition. So then, say we've decided to just basically stick on some rollup solution on top of Ethereum. 2 names in the game are zero knowledge rollups and optimistic rollups. Again, it's kind of, you touched on this a little bit already, but one of the really awesome things about what StarkWare is doing with the zero knowledge rollups is that they have instant finality once the batch is presented on chain. One of the downsides of optimistic rollups is that they rely on they basically, first of all, rely on game theory. And then second of all, they rely on a really, really long challenge period, where effectively on optimistic rollups, the batch operators can put out whatever state update they want to. It could be anything, could be something that's valid, could be something that's invalid. And the whole thing that optimistic rollups rely on, there's kind of third parties watching what these operators are doing, and then just making sure that they didn't include any invalid transactions. And roughly, to my knowledge, kind of optimistic rollups usually need a withdrawal time or kind of about a week before users can actually withdraw from the system. And that was really, really tough for us to think through kind of from a product perspective, like who's going to want to use an exchange where it takes a week to withdraw? Probably not that many people. And there are ways to get around this. And kind of the main thing that you can do both on optimistic rollups and also what we are doing on kind of zero knowledge rollups is you can do something called fast withdrawals, which basically have a central liquidity provider, which will front all of the capital for the withdrawals on the exchange. And we figured we could do this on both optimistic rollups and kind of zero knowledge rollups. But the problem with doing it on optimistic rollups is that capital provider has to have capital proportional to all of the withdrawals that happen for the entire exchange for a week. And that's just like an absolutely massive amount of capital to have, and something that was just for us like pretty untenable. Whereas what we're doing with kind of StarkWare and with the zero knowledge rollups is we support two different withdrawal modes. So we support what we call as like slow withdrawals. They aren't actually that slow. It basically just takes like a few hours until kind of the Stark batch is submitted on chain, and then the user can withdraw. But you don't even have to wait that long. So we're kind of doing the same thing. We also offer fast withdrawals on the exchange, which are just as fast as any withdrawal you get on any other DeFi product, where we'll basically use kind of a central liquidity provider and be able to just give the users their capital much more quickly. So I guess to summarize, it's like production readiness was super important. StarkWare is clearly the leader in that. Being able to have the security and decentralization and wallets and all the tools of kind of an Ethereum or like an Ethereum-based rollup, that's what StarkWare can provide. And then just being able to have really great cryptographic guarantees and also shorter withdrawal times and kind of capital requirements for liquidity providers are the main reasons why we went with StarkWare.
Great. So I know you touched on a few of these, but Uri, what do you view as the main trade-offs between ZK rollups and optimistic rollups? And maybe can you contrast kind of the trade-offs around capital efficiency, security, and scalability?
Sure. So in terms of scalability, and this was demonstrated this past summer, Reddit had their big scaling bake-off at a fundamental level, and then manifest also at the practical and then the demonstrations that were submitted there. Zero knowledge proofs, zero knowledge rollups, ZK rollups are fundamentally more scalable than optimistic rollups. At the end of the day, there needs to be less data per transaction placed on chain. So just to give an example from the Reddit scaling bake-off, we could, because of the way that ZK rollups work, and because of the power of Cairo, which is the language that we've developed that powers our ZK rollups, we could prove not every transaction in the batch, the value of every transaction in the batch, but rather the net sum of transactions included in the batch. So if in a given batch, David and Antonio transact 100 times, the data that we would submit on-chain would be the net change to your balances after those 100 transactions. Whereas in an optimistic rollup, you have no other choice other than to record those 100 transactions. So those ZK rollups are fundamentally more scalable. Now, as Antonio pointed out, because of the long withdrawal times with optimistic rollups, that means that capital efficiency is as a practical matter, 1,000, and this is not a drill, this is an actual number, 1,000 times less efficient in optimistic rollups. And that's a huge, huge difference. So imagine a Uniswap and Uniswap Prime, one running on optimistic rollup, one running on a ZK rollup. Any liquidity provider that can make 1,000 times more money, elsewhere would of course move over to the ZK rollup system. Now, within optimistic rollups, there's a fundamental trade-off which we've written about extensively between the security of the system and its capital efficiency. So if you say, well, a week is way too long in terms of withdrawal window in an optimistic rollup system, let me shorten that to a day and improve capital efficiency, you've just made your system far less secure. Because as it is protected by crypto economic incentives, now the hurdle that an attacker needs to overcome is to attack the system for a day, not for a week. And that, by definition, is at least 7 times cheaper, probably better than that. And so that's a fundamental trade-off that exists in optimistic rollups. The prevailing view in this regard is that the allure of optimistic rollups is that they are closer to production, which I think is an interesting and almost amusing perspective, in the sense that ZK Rollups, there are multiple systems on mainnet, have been for a while. Other than our system, there's Hermes, there's Loopring, there's ZK Sync, etc. Optimistic Rollup, they are sort of walking around still with a proverbial trusted crutches, right, to protect the system. I think we're going to see a lot of innovation in that space. But I think the conventional wisdom, as manifest in the Vitalik post from a couple of months ago, is that optimistic rollups are going to be sort of a better solution in the near term, and ZK rollups are going to dominate in the mid to long term. As I think we're going to show with dYdX, ZK rollups are going to be a dominant solution in the very, very near term. So that's a couple of weeks away.
Great. And then maybe double clicking a little on like how layer 2 works and what the different components are. One question that came up is, what are ZK provers? Who is operating the ZK prover? Is this done by StarkWare? And what measures are you taking to make sure that layer 2 is available without outages?
Sure. So right now, ZK Provers is a cloud service which receives from the operator, in this case dYdX, batches of transactions and generates proofs attesting to the validity of the transactions in that manner. And those proofs are then submitted to the blockchain and so on and so forth. We talked about them. Now, this is a cloud service. This is essentially, think of this as a SaaS service. There are a couple of things that we're doing to make sure that, other than sort of the standard measures taken by cloud providers to make sure that there's no downtime, etc. At a deeper level, we're taking 2 important steps. One of them is StarkNet. StarkNet is our vision, our roadmap for a trustless, decentralized ZK rollup. We've published a post about this in early January. This is a 3-step roadmap. The first step will be on Ropsten in about 3 months' time. And in this vision, the network will be fully decentralized at all layers, including the prover layer. So there will be multiple layers. It will be a permissionless network, meaning anyone would be able to function as a prover. In addition to that, we're going to be publishing the source code for a prover under a new license that we've defined together with our formidable and competitors and good friends at AdStack. And we refer to this as the Polaris license. And this is an interesting license in the sense that it says that anyone can run this prover code. They don't need any interaction with us, and they can do this for all posterity, as long as the proofs are submitted to a whitelisted smart contract on the blockchain. And an important addition to that is that whitelist of verifier smart contracts on-chain is an append-only list, meaning if you as a developer see a verifier on-chain that you like its functionality, you like its fees, etc., you are guaranteed under the Polaris license to have this level of service and these terms for all eternity, without ever talking to us. And we think that that greatly minimizes any platform risk that developers would conceivably see in building their platform on top of a relatively newcomer like StarkWare.
Great. So I guess taking a step back and looking kind of at what's ahead, Antonio, you mentioned a lot of new trading pairs on dYdX. Can you maybe describe, the types of trading pairs that will be listed and kind of what's the timeline for adding new pairs over the coming weeks and months?
Sure thing. So on the current alpha product, because it's just an alpha product and users are trading with capped amounts of funds right now, we still only have the same assets same markets on the platform that we did on layer 1 for perpetuals. So we have Bitcoin, ETH, and Link right now. Right after we do the public launch, one of our main focuses is going to be immediately just continuing to launch a lot of new markets at what we feel is a pretty rapid pace on the exchange, targeting about one a week or so, if not more. We aren't going to release exactly which markets we're going to be listing, but it's not exactly rocket science. Kind of the things that we're focusing on, they're kind of the relative like top 10 coins. And then we're also going to be focusing on specifically DeFi coins. And we think that makes a lot of sense because obviously anybody who's using dYdX is on Ethereum, they're using a DeFi product, and it may make sense that they want to trade coins for like other similar products. So that's what we'd be focusing on, is just kind of launching one market a week, and then also just a bunch of DeFi coins plus like the top 10 coins for other chains as well.
Great. And then obviously, layer 2 vastly improves the user experience on dYdX. What would you say is dYdX's strategy for taking away market share from centralized exchanges? And then aside from non-custodianship, what other competitive advantages does dYdX offer to users?
Yeah, I think being able to trade on a non-custodial exchange is the main selling point. So this is just something users are used to on any DeFi platform that's worth its salt, and dYdX is no exception to that. So when you're trading on dYdX, you remain in full control of your funds at all times, and there's nothing dYdX Inc. can do to take your funds away from you, and that's just a much more secure way to trade, as we've seen over the years. Another really important thing and kind of another advantage that we offer right now is just a really big increase in the amount of transparency that we're able to offer to our users. And this is especially important when users are trading more advanced types of financial products like synthetics. Because when you're trading a synthetic product on a centralized exchange, not only are you trusting all of your funds to the exchange, you're also trusting that the exchange will execute kind of the terms of the contract that you're entering into in accordance with what you agreed to. But it's really kind of a big black box when you're trading on a centralized exchange. It's like relatively unclear how things like collateral ratios work, how liquidations work, how big the insurance fund is, like if people are getting deleveraged, things like that. Just a lot of like pretty technical aspects of the contracts people are trading. Whereas on dYdX, all of this is public. So you can just go and take a look at our smart contracts. You can go and take a look at kind of the transactions and the data that's on chain, and just have a lot of confidence that the contracts that you're entering into are being honored. And it's just a really effective way for us to bootstrap trust. So those, I think, are the main benefits that we're working on now. And I think for the long term, and one of the things that Uri alluded to that they're going to be focusing on a lot in the future is just being able to kind of distribute or decentralize basically the StarkWare provers themselves. One of the things that we're going to be working on in the long term is just also decentralizing kind of the entire platform itself, and just being able to kind of move away from the central order book and the central matching model that we have now. So I think that you'll just continue to see just a really high quality product from us. And over time, this will be available just as open source code that anyone can interact with on the blockchain.
You mentioned decentralizing parts of the order book and kind of creating a community around dYdX. Can you maybe share a little more about your plans or dYdX's plans to support and create a community? And what are some ways for community developers to contribute to the overall dYdX ecosystem?
Yeah, in terms of the work that we're doing to just build community, I think this is a lot of the work that David himself is doing, and just kind of the broader growth team that we've brought in. This has been a really big focus for us over the past few months, and it's especially been a really big focus for us on the international side. So synthetic contracts are especially popular internationally, obviously, and especially in Asia, and more specifically China. That's been a really big focus for us in terms of being able to grow that market. We just hired our first employee in China, Yuran, who's been doing a great job getting a lot of traction for us and a lot of community engagement in that market. And China was actually by far the biggest market in terms of alpha signups. So one really exciting metric that we had is we have I think it's currently over like 90,000 or something like that signups that we've gotten for the alpha, and roughly like 2/3 of those have come from China. So I think we're just continuing to execute pretty well, and hopefully we'll continue to do an even better job in the future of just getting more community engagement, especially abroad. But we really see dYdX as worldwide and global, and that is one of the big advantages for cryptocurrency and cryptocurrency exchanges, and especially decentralized exchanges, that you can offer a really global product, can localize it to a bunch of different markets, and that's one of the big focuses for us now.
And then Uri, you've onboarded a number of projects already to StarkWare. What is your strategy to onboard more projects to layer 2? And then specifically, is StarkWare working on a Solidity to Cairo compiler, and any ETA on when that could be available?
Sure. So at the heart of our approach here in terms of sort of scaling out the business and allowing developers access and permissionless access to our software stack is making Cairo available to any developer. And that, in fact, is already the case today. You can go to cairolang.org. There's a browser-based IDE, allows any developer to write whatever business logic they want in Cairo, send that code to be proven via our cloud service, and the proof and the result of that off-chain computation. The proof will be verified on Ropsten on the Ethereum testnet, and the result of the computation will be recorded on Ropsten. So any developer can today write a scalable dApp that basically runs on Cairo. That's already the case today. This coming Sunday, and you can find the invites on our Twitter feed, which is StarkWare Ltd, StarkWare Limited. This coming Sunday, we have a Cairo 101 workshop. Over 100 folks have registered so far. There's tremendous interest in this. So this is sort of the heart of our approach, and there's a whole bunch of tools that we're offering around this and that we're developing in-house, and soon we'll start engaging the ecosystem in developing these tools. And this includes, of course, compilers, and compilers not only from Solidity, but from other higher level languages that would allow people to write in their language of choice and compile that to Cairo. At the end of the day, I think that different languages will be used for different use cases, questions of efficiency, of security, of familiarity. And so I think the design space around compilation or translation versus writing in Cairo, more efficient code, we'll see how that pans out over the coming year or two. But I think it's going to be a very exciting period and a very exciting thing to observe.
Definitely an exciting period. I guess, Antonio, can you describe how hard it was to get set up and running on Cairo, and any lesson learned or advice to other DeFi protocols looking to integrate with Cairo?
Sure thing. So for us and kind of our integration with StarkWare, we basically had StarkWare themselves and kind of their team write kind of the Cairo programs for us. And I think that was, and Uri can talk a lot more about this, I think, but that I think was mostly like a legacy thing, or one of the big things they've been working on kind of in parallel in the 6 months that we've been working on this project with them, is just building out Cairo as a fully fledged language that is available, and that just makes it a lot easier for developers themselves to write contracts. So I can't comment too much on that in particular, but we're really excited to use that for a lot of things in the future. I think it'll just make it so to be that, for the next product that dYdX builds on top of StarkWare, it won't even take us like 6 months to build. It'll probably be a lot faster than that, because just our developers can come in. Exactly.
I think it'll be much faster than I can get. This is real anecdotal evidence, but on Cairo Lang, one developer showed up one day, the internet being the internet, and a guy we did not know, and used Cairo, and over the course of a couple of days wrote the functionality, a payment processor. So the functionality identical to ZK Sync or Hermes. And to me, that was mind-blowing, that someone who doesn't know anything about zero-knowledge proofs, all this black magic was abstracted away under the hood for him, and he can just focus on the business logic and very easily, in a couple of days' time, have this system up and running. So I think that the dYdX folks and other teams will discover that whatever business logic they want to implement, this will be a very simple task. with the sort of the fast evolving tool chain around Chiron.
Great. I guess switching gears a little, you know, a lot of people attribute a lot of the growth in DeFi to composability. Antonio, can you share kind of what the impact to moving to layer 2, you know, what impact does that have on composability for dYdX?
Yeah. So I have kind of a counterculture view on this when it comes to DeFi. First of all, I think people say composability, and a lot of times like they don't understand exactly what that means for like any given specific protocol. One of the interesting things about us at dYdX is, first of all, I think we take a really full stack approach to building products. So we prefer to build everything in-house, from kind of the smart contracts to kind of the servers that run our matching to kind of the user interface and the products. And if somebody else is building it, I mean, we just fundamentally believe like internally we have a really strong engineering team and we'll be able to build it better specifically for our product and our traders. And our goal is pretty narrow in that we just want to make the best possible product for traders of advanced financial products and specifically perpetuals. And the reason why I think that itself is just a really valuable goal is because the market for perpetuals is literally bigger than the entire rest of the cryptocurrency market put together. So by just focusing on this one use case, we can just make, you know, dYdX can become one of the biggest exchanges in crypto in a few years, which is our goal. So definitely another interesting thing is that because we are a product that offers synthetics, because that basically means that, again, like we don't actually need like any of the coins that we're trading to exist on kind of the chain that we're trading on. Which basically allows us to move to layer 2 a lot faster, and kind of enables us to like support like a wider array of different like layer 2 solutions. You know, StarkWare, one of the cool things about rollups though is that you actually can support like a bunch of different coins as like deposits into the system. So to give you an example of like one cool thing we're doing with composability that I think does positively impact the product quite a lot, and that's still possible because StarkWare rolls back up to layer 1 Ethereum. We basically have an integration with 0x API, which is one of the leading decentralized exchange aggregators, which makes it really easy if users come to our platform with like any given cryptocurrency. We can just use 0x API and then atomically basically use that to have the user make a trade and then just deposit to StarkWare's layer 2 contracts. But I think that's one of the reasons why I was saying before, why you see a lot of the synthetic protocols. So like us and like synthetics, you know, being an early adopter of like Optimism as an example, just moving to layer 2 before others, is that, you know, they're more kind of full stack products than what you would see for a lot of the rest of DeFi. And that just enables them to move faster.
Great. And I guess as a complement to composability is really, you know, interoperability. Uri, can you transfer funds between different StarkWare solutions, you know, from diversified to dYdX?
Yeah, so we've actually published about this, what we refer to as interoperability. And this functionality is not enabled yet, but it's a very simple mechanism. And it is essentially the same mechanism that powers fast withdrawals. So in the fast withdrawals, you move funds from layer 2 to any address on layer 1. Interoperability that you asked about, David, say between dYdX or Badger DAO or Immutable X and all these systems that are coming over the coming weeks and months. It's essentially the same mechanism. You have a liquidity provider at your destination environment, whether it's layer 1 or some other layer 2, and they would send funds to you once you've presented them with what we refer to as a conditional IOU, a cryptographic IOU that basically says, let's say I'm moving funds from dYdX to my account diversified, and you, David, are the liquidity provider. I basically tell you, David, here's a cryptographic IOU that says I will pay you 1 ETH here at dYdX plus your fee if you give me 1 ETH now to my account on the And so this is the basic building block, the conditional transactions, cryptographic IOUs that powers interoperability across layer 2s. Now, going outside of the StarkX ecosystem to other zero-knowledge proofs should be as simple as that. Moving funds across layer 2s, meaning from ZK Rollups, say, to optimistic rollups and back, Conceptually that is also possible. The 1 week withdrawal time and all that stuff comes into play. But I think there's a strong motivation on everyone's part in the layer 2 space to spare applications the need to interoperate via layer 1. Meaning, if the only way for you to get from an Optimism system to a StarkWare system is by going out to layer 1, jumping over to the other smart contract, etc., that's a massive nuisance. And so all these layer 2 islands, so to speak, I think will have a very strong motivation to interconnect as soon as they can in order to increase the size of the pie. So we're going to see that. That's my expectation.
Great. And so, obviously a lot, most DeFi protocols today are evaluating kind of different layer 2 solutions and looking at, dYdX and a number of other protocols who've already made the jump to better understand kind of what the competitive landscape looks like. I guess, Uri, in your view, what does the future of scalability on layer 2 look like? How will the ecosystem evolve over the next, 12 to 24 months?
So my expectation is that it's going to remain a very busy and noisy and fast-moving environment. And I think that there is a crowd that expects sort of the dust to settle and everyone to just go to one particular layer 2 and not the others. And I think that's a very naive expectation. And I think it's naive because of competitive pressures. And I think it's naive because in a fundamental way, the different layer 2 solutions optimize for different parameters in this multidimensional design space. And different applications have different needs in sort of a very fundamental level. And so whatever. dYdX has different needs from Uniswap, fundamentally so. So I think we're going to see a plethora of these different layer 2 solutions over the coming years. And I want to add to that we're of the opinion that layer 1 is going to continue to be a crucial environment, not only for sort of verifying things like zero knowledge proofs, etc., but actually for a lot of the activity that we see today. So this expectation that, okay, just forget it, don't worry about Ethereum, everything is just going to go into some layer 2, I don't think that's going to happen. And so we're building systems based on that premise. We have our DeFi pooling concept basically abides by that sort of assumption, which is to say DeFi is going to remain on layer 1. It was born there, it's going to remain on layer 1. And what you can move to layer 2 is the user demand for various DeFi services where users can pool resources, interact cost effectively on layer 1. So we think that layer 1 and layer 2 are going to continue to operate in a very sort of intimate fashion over the coming years. It's not going to be some mass migration to any layer.
Antonio, do you share the same view on the future of layer 2 versus layer 1?
Yeah, I mean, I think I mostly agree. I think it will definitely take time for people to migrate over to layer 2. I think it is interesting, as Uri said, that there seems to be like a bit of a breakup in terms of like a lot of different projects like moving to different layer 2s. I think the concerns around like composability and things like that are valid, and I'm interested to see what happens with that. I also agree with Uri that I think a big thing for different layer 2s will be composability or compatibility with at least moving funds, if not more interesting things from layer 2 to layer 2. So I find that pretty interesting as well. But yeah, I think over the next 12 to 24 months, I actually don't really think that's that long. I think there will be just a lot of people moving to different layer 2s, and then we'll have to reevaluate in probably a year or two, see what kind of the advantages of that were, see what potentially some of the things that aren't quite as optimal as they were on layer 1 Ethereum, where it's basically happy land and you can just call any smart contract that you want to really easily. And I'm sure that will just cause a lot of other innovation on layer 2s themselves, so we can continue to push for a lot of the technical stuff there.
Great. I guess just going back to a comment that Antonio made on decentralizing the order books, can you describe what are some of the components of dYdX which are currently centralized and specifically order books, how you plan to decentralize them and solve the real-time issue?
Sure thing. So let's maybe talk about like the current state of what we have right now. So dYdX is what's known as a hybrid exchange, which means that, as you say, we have some centralized components, which are the order book and then kind of the order matching. And then we have some decentralized components, which of course are, all of StarkWare system and all the smart contracts that are running on chain. And right now, the reason we have the order books and kind of the order matching in a central way is basically just for performance. So it just allows like users and traders on the exchange, and specifically like programmatic traders especially, to just be able to build a lot more liquidity by having the same performance that they would expect from a centralized exchange. And that's pretty different than, at least like right now, what's available like on chain or like on some like scalability solution. And we think that that's just one of the things that gives like dYdX its really big leg up in terms of user experience right now. Right now we support order books rather than building on like automated market makers. Order books, I think, are just much more efficient in terms of building liquidity. I think they're not objectively better. Like I think AMMs are better for supporting kind of like the long tail of assets and kind of markets that users might want to trade. But it all kind of goes back to what our goal is at dYdX, and that's just becoming one of the biggest exchanges in crypto, period, but on kind of like a 3 to 5 year time horizon. And if we want to become one of the biggest exchanges, we have to support the biggest markets in the highest quality way. Like literally just Bitcoin perpetuals are almost bigger than kind of the entire market put together, rest of the market put together. And so we have to have like a really great trading experience. Roughly, I think order books are kind of able to translate a given amount of capital into like 100 to like 1,000x more liquidity than what AMMs are able to do right now. In terms of like being able to decentralize kind of different aspects of our stack over time, this is still very much a research project, and like want to be open and upfront about that. Like we don't have all the answers right now. Some things that are like some technologies that we're interested in are potentially like adopting kind of like a request for quote system to kind of supplement other liquidity models, potentially building on-chain order books, and then potentially just evaluating whether like our liquidity can also be supplemented by AMMs. And the cool thing about these different liquidity models is that they're not mutually exclusive. Like you can imagine a system that had maybe like an on-chain order book if there were sufficient scalability to build that on-chain. And then something that also had maybe like a request for quote model that we're running in parallel with that. And these are the kinds of things that we're going to be focusing a lot over the next like year or two and then building out.
One last question. I guess it goes back to the scalability question. Obviously, this past week, there was a lot of news around EIP 1559 and, a fork around that later this summer. If that EIP works out well, Antonio, would you consider returning to layer 1, or do you think that layer 2 is really the future?
No, it's like not even possible. Like it's not like the construction of like Ethereum is like fundamentally doesn't support like that many transactions. It doesn't really matter like how you decide like which transactions to put on like layer 1. If the thing can only handle like X transactions per second, and you want to support more transactions than X per second, then you just like fundamentally can't use it. So it's not like this is a temporary thing. This is the future, and that's why we're excited to work with StarkWare on it.
That would be a surprising move, migrating back to it.
Yeah,
Done here.
For anyone, yeah.
Yeah, for sure.
For anyone.
Great. Well, Uri, Antonio, thank you so much. I think that wraps up all of the questions that we got from our community of users. I think just to wrap things up, Antonio, do you want to give a short live demo of the new platform for users to see what it looks like?
I would love to. Yeah, and I think this is probably the best way to do it, is just let our product speak for itself. But here we go on Alpha, and this is currently live on mainnet right now. This is trading with real money. This is on StarkWare's live system, rolling up to real Ethereum. And this is the product that we built. Obviously, it looks like an exchange. Like to think that kind of the user interface and design is much spiffier than what we had on layer 1. But the cool thing about it, and kind of the killer feature, is that you can trade on this exchange with leverage. So you see, I already have a position that's open here, pretty highly leveraged actually, and luckily enough, I've had this sitting open and just made a little bit of money. But first of all, let's go ahead and just close this position. And first of all, the thing that I want to call out right here is the fee that I'm going to pay to close this position. So this is what, like $250 trade, and I'm paying 36 cents in fees. Just anybody who's using DeFi right now should just salivate over that as the first thing. And then the thing I want you to watch is, like, as I close this position, how quickly the UI updates. So click, that's it. It's filled. It's already live. It's already final, like, on the product. I can go over here to orders, see that my order has been filled, go over here to fill, see exactly the price that I got, and did in fact pay that 36 cents in fees. And that's basically the whole thing. The other cool thing, and kind of the other really killer feature, I think, of dYdX, and by extension, just like leveraged exchanges, is this up here in the top left. This kind of like this concept of buying power and free collateral. Free collateral is basically just like the amount of money I have on the exchange, but this is translated times 25x. Buying power is kind of the maximum amounts that I can buy. So I literally have less than $15 on the exchange, right? But I can go over here. I can immediately start just like buying, like, 0.004 Bitcoin, or I can buy like over $200 worth of Bitcoin with this $15 that I have on the exchange. And if there's just kind of one concept that you want to like really wrap your mind around with using some of these more advanced products like perpetuals, it is this concept of leverage. Where you can just come to the exchange and you can immediately start trading as if you had a lot more capital. And it's not free, right? There is also a lot of increased risk when you're trading in this way. So it's really important to understand how to use that risk and how to mitigate it. But dYdX also gives you a lot of really cool tools to be able to do that. So we support, of course, limit orders on the exchange. Can just support, anybody can place like a resting limit order. That'll just like immediately pop up on the book right when you place it. We support stop orders. Stop orders are pretty cool too. And this gets at kind of the point I was making about being able to kind of mitigate some of the risk and mitigate some of the downside. Basically what a stop order is like if you lose like more than a certain amount of money, or kind of the price. Say you take like a long position, but you were wrong and the price actually starts falling, you can place a stop order to just close your position before you actually lost too much money. So we support normal stop orders. We also support trailing stop orders. This is a really cool order type because what trailing stop orders mean is if the price of your position, or like the amount of money you lose on your position ever exceeds like 10% from whatever the all-time high is of your position, then it'll just close your position. So you could basically say, okay, like the price of Bitcoin is $55,000. I'll go long right now. I'm going to place a trailing stop of 10%. And then if Bitcoin like starts going up, your stop price will just keep trailing the price of the position that you open, like all the way up. So like Bitcoin could go like to 60K and then like drop back down to like 55K, and your position would be automatically closed. So basically what I'm getting at here is dYdX, we really support like a similar trading experience, I like to think, to what's available on centralized exchanges, just as fast. We support almost as high leverage as centralized exchanges do, and we'll probably increase that in the future, just starting out on the conservative side. Binance put out so right now we support 25x maximum leverage on BTC and ETH. Binance put out some interesting data on their users' usage of leverage. And basically said that kind of the 20x leverage was by far the most popular leverage, and we support that on dYdX today. So that's basically it. Also keep in mind, this is kind of an early like alpha product. We'll continue to iterate on this, continue to build out like a lot more features on the product over time, and excited to roll this out to everybody publicly really soon. But in the meantime, if you're interested in trying it out yourself, just head on over to our website, dYdX.exchange, sign up for our alpha so you can start playing with it as soon as possible. It's really cool to use. I don't know, especially to me, just like being able to make a trade and finally have it update immediately, finally paying like reasonable fees in DeFi, being able to trade with leverage. At least I think that makes this a really killer product, and we're excited to launch soon.
Hear, hear.
Great. Well, I think we can call it there. Yeah, thanks so much, everyone, for joining. Really appreciate all the great questions. Like I said, excited to launch the product soon. And until then, we'll keep building. Yeah, thanks, everyone.
Thank you, everyone.
Thanks, everyone.